inflation update relative to the business cycle modeling. I'm Rich Possible Critical Points, May 13. Okay, this is a chart of inflation relative to CPI. And what we can see is it rolled over in the recent report. Stock market didn't think it rolled over enough, sold off. Bond market, interesting enough, moved up price-wise. Interest rates came down as if it was respecting that, as if it was considering a chance for a top. Until we see this rate move higher than the high of this year, and this is an annual year-on-year rate, until it moves higher than that, there is a chance the market's peaked. We're calling it as peaked, but there's still risk in the next few months or even the rest of this year that it could still move higher on us because we're seeing some components coming down, but we're seeing some components now moving up at a faster pace, and it's a little bit iffy of how that all comes out to the actual CPI number, okay? Now, cyclically, how inflation has worked is that inflation bottomed with the 2008-2009 financial crisis for a super cycle. And it did improve a little bit, but then during the 2010s, the Federal Reserve had a very difficult time getting inflation up to 2%. Because it felt like at 2%, you probably will have a better GDP and a better economy, but the inflation wouldn't be high enough to cause some negativity inside that economy. So they thought there was a safe level. And they were just discouraged. And of course, everyone picked on the Fed that they just would not go to 2%. Okay. Well, what it was doing was basically waiting for the interest rate market to put in a super cycle bottom along with a once a decade recession around the time of 2020. And of course, we know what it was. It was the virus pandemic recession did that. So what it was is it put in a decade bottom for inflation then after the super cycle bottom in 2008, 2009. And then, so therefore we have the super cycles now up, and they may be up for decades, at least in the next decade is my opinion. And then we have the long term that's up for this decade. Now, what we mean by this is the reason the long term is a component of the super long term is that towards the end of this decade, we'll probably get a recession and inflation will come down, interest rates will come down, and then we're just going to recycle and start it all over, put inflation back up next decade along with interest rates. And the point is, it may even go higher still because of those super cycles. We don't know yet. My gut feeling is these super cycles are not as bullish as with prior generations. We're not going back to 1980s, 17 to 20% inflation. We're not going back to 10, 12% inflation and the 17 to 20% interest rates is what I should say, okay? So things are going to fluctuate anyways. Our best guess for this decade is we're really more like a combination of the 1950s, 1960s, when we had spurts of inflation, but then it kind of leveled off. And then the 1970s, where it shot up in the beginning of the 1970s and stayed high for the rest of the decade. It averaged like 7% a year inflation. Unbelievable, okay? And then the 60s and 50s, it was really only 2.5%, 3.5%, okay? We're probably going to come back to 3% this decade and perhaps for the decade. So in other words, the Fed may now find it difficult to get it down to 2% or lower unless we actually have a recession. And the best guess for recession is near the end of this decade, but we want to watch out mid-decade. We can have not so good real estate prices. We can have poor commodity prices, and that all can weigh on inflation, bringing it down. But will we also have some economic issues? For the moment, it doesn't look like it'll turn into a national true recession, but it can be something like it, okay? And the stock market may have some issues mid-decade. But in the meantime, it doesn't look like we're heading into any recession anytime soon. I've got at less than 10% probability. When I throw on my business cycle timeline, maybe I can get up to 20%. Some of the economists are up to 30%, okay? But I like my method better, okay? So I think I'm right on that. All right, but we will see, okay? The Fed yesterday warned maybe we got to go into a recession just to kill this inflation, okay? That was upsetting for the stock market for a little while, and then it kind of shrugged it off. They weren't saying that's how they would play the game. They're just saying, you never know, okay? So at any rate, I'd like to think it's peaked for this decade. We've seen the highest, but the point, and it can come down a huge amount by next year. and it could be rolling over now. So do we have any evidence, at least from the commodity side? Because we're already hearing stories, used car prices easing back, some of the other components. Unfortunately, we're hearing food prices actually now speeding up. So that comes of this weird mixture here of some things slowing down, some things speeding up. So where's the final result of CPI? And next week we'll get a PPI inflation. Somewheres this month we'll get a PCE, which is important for some of the Federal Reserve. That's just another measurement of inflation. Anyways, this is the lumber prices. We called a long-term top, okay, back in 2021 May, or a little after as it started to turn down. And we said, we just drew a line and said, this is going to be a long-term bear market. Yes, it rallied quite well. We felt like that was seasonal factors, some after lingering momentum, after shocks, whatever. But it topped for what's called level ones, which are the more important fluctuations during a year. And it's turned down, and this month it's behaving very well for us. This is not actual price targets by no means. It's just giving a general guideline of the direction. In theory, lumber could bottom for a minor long-term business cycle bottom in June. And therefore, it could start working higher into 2023 for a related top. But we're thinking it's probably not going back to the 2021 high. What it would mean is likely a trading range in this area. So this may add to inflation at times, take away from inflation. But the problem is lumber doesn't have to bottom to about February 2023, the latest. We can even put it out a little bit farther than that, maybe if we get the right conditions. We're kind of thinking it's down into the fourth quarter of this year, maybe the start of next year. So we think there's more downside of lumber coming, and that should help in terms of lowering some costs to build homes. But at the same time, the demand, what the reason it's doing this is the demand's starting to back away because of these higher interest rates slowing our economy down a bit. But the economy's still going to grow strong, even with the slowing down of the economy. Okay? So the next thing we want to look at are copper prices. A lot of people view that copper is an indication of the economy. Well, we believe that as of March of this year, one of those level ones during the year, we need those to also help us time a long-term top. We think not only was it a minor long-term top, but it's possible it's a major long-term top, meaning we may be looking at the highest price for the rest of this decade, or at least the next 3 to 5, maybe 7 years, okay? But in all commodities, in other words, way back in the mid 2010s to late 2010s, I said we got to look out for a bull market in commodities from 2021 to 2024, but it should top during that time frame. You get to bull market, but it's over during that time, and then it's down. So something might go wrong. The copper's still higher in the next couple of years, or nearly as high, something like that. But there's a chance that they just ran it up too fast. We will rebuild the supplies, fix the supply chains. Some of these commodities, it may be all over this year. For some of them may have been over last year. Some might get their second wind, if you will. Something, maybe a supply crunch like over in the grains could very well occur off of weather issues. There could still be some lingering bullish the next couple of years. But at any rate, for copper, for the moment anyways, until it takes out this high, we are at least bearish into a minor long-term bottom that may not occur now to 2024. That doesn't mean that we won't see some important tops along the way to snap it back up. It's not going to drop non-stop. It's not going to probably come all the way back to $2 here, but it can retrace quite a bit. I'm thinking 3,500 to 3,000 going out to 2024. And even if that's too low, still late this decade, it could finally get there. Okay, and yes, we are super cycle bulls in commodities into next decade when we think a top's going to occur like once every few generations or something like that. But and then that does mean we could see higher prices by then, but it doesn't mean we see higher prices from now until then. We can have huge setbacks. Okay. So personally, I don't think copper is a good hedge for inflation unless you're trading it just short term, meaning you're basically a commodities trader, but you're kind of using it as a tactic or strategy of saying you're trying to help out to hedge with inflation. I just don't trust it, okay? Now, what we want to do is take a look at the gold market. This is our monthly chart of gold futures, and we've got some minor long-term to major business cycle, tops and bottoms. And we believe that gold put a bottom in last year And it is in a bull market until about July of this year on into May of next year. So a very wide range. There's lots of things that go right or wrong, create various fluctuations. But we're not pleased that it stopped near the long-term high, the last long-term high of August 2020. And look how much it's sold off. And you see these lines here? This is from a forecast done months ago where we said, well, it might go down into a long-term bottom next year. It might go up into a long-term top this year to early next year, then fall back. We just don't know for sure. We understood this rally here off the Russia-Ukraine, but it looks like gold has been telling us for more than a year now that this inflation story is not going to last. It's not going all decade. It's not a 1970s scenario. And I think the gold market is actually smarter than all the people who are so gung-ho on inflation and so scared over inflation. And I think the bond market's kind of telling us those kind of things too. I think the bond market, gold market, no. We can kill inflation with higher interest rates, even if we may have to throw ourselves into a recession, have a bad time economic-wise, but we can kill it. It can be a Paul Volcker moment back in 1980. Hey, kill the economy in order to kill the inflation, and then bring back the economy, but hopefully something has changed. You don't bring back the inflation. And it worked in the 1980s. And then that set up a trend of lower and lower inflation from 1980s right into 2008, 2009. And lower interest rates right into just a few years ago, okay, back in 2020. That 40-year trend of lower interest rates is probably over. We're going to have higher interest rates the next few decades, long inflation, but I'm not convinced they're going up huge amounts. It's more likely we'll get spurts here, jump it up, level it off, eventually we'll bring it down for every recession, in my opinion, okay? So I think the gold market has kind of figured a lot of this out. And some people thought Bitcoin was stealing some of the inflation hedge demand for gold. But Bitcoin has turned out to be a horrible investment to hedge for inflation, a protective tool. And so I think they've given up on that. And apparently the money did not flow back from Bitcoin into gold. Okay, I just don't like gold. I think the better idea is it's going lower over the next few to several years, but it may not go lower by huge amounts. It may just stall out, okay? So it's giving us a clue that inflation isn't sustainable, isn't going to really destroy things. It isn't going to be a 1970s scenario. But the point is we are in the early 1970s phase, and that's why Paul over at the Federal Reserve is saying if we have to, we will act like Paul Volcker. We'll hammer things if we have to. We'll get those rates up there, okay? So how about commodity indexes? This is the Goldman Sachs Equal Weighted Index, meaning there's a little less energy in it. One of the problems with most commodity indexes are very heavily weighted energy, and that's not fair to the other commodities. Doesn't tell us the true picture here. Well, this one's more equal weighted, okay? It's going to have more agriculture metals mixed in with all that energy, okay? Well, big spike up off Russia-Ukraine. We're thinking minor long-term top, but we can see how it could struggle a little bit higher and top out a little later this year. It may have a rebound off of grains and livestock and some of these, and maybe some of the non-gold metals. And then what else was I trying to think of there? Basically, try to have some lingering inflation side of things, okay? But at the same time, we can see a scenario when this index is going down over the next few years, over the next several years. It can pull back some. It should not go back to this bottom. I think it's just going to retrace a sizable portion over several years. And next decade, it could have another major bull market, at least for a few years, and maybe put this index even higher then. But we're not picking up a reason to bet on the upside. You can if you want. This could be just a little correction before going higher. But the message I want to send here is I've been a commodity trader for 30, 40 years, as well as a stock market trader, and then a long-term investor in stocks. And to me, the only reason to hedge with the use of commodities is if you trade them short-term now. The big game is over, okay? I'm just not seeing the sustainability here to make it work. And I think it's going to be better for the economy if we actually back off some of these commodities and help back off inflation. This is a monthly chart of the DBA fund. It's by Deutsche Bank. It's an agriculture fund. It still looks like it can work higher over the next few months here maybe. Trend is still up. It's still a bull market. But if it starts to trade below the low of this month at $21.27 per share, I think there's a possibility we got a long-term top in commodities, okay? Now, individually, the grains can still be bullish next year, maybe even the following year off of weather problems. Maybe we can have a weather problem this year, and maybe it can just explode it higher. So we have to be a little bit careful with that. But overall, we're seeing some signs of a chance that inflation can roll over this year, okay? And I think it could be down quite a bit next year, even though we can have certain commodities bouncing. Now, it's not all about commodities. It's also about commodities drifting through the food chain, the pipeline, the supply-demand chains down to the consumer. So a lot of businesses add to this. They're trying to make extra money. They could hold prices up for quite a while, even while the commodities actually drop. And then, of course, there's wages. How much are people being paid, and are they going to get paid more? So it gets a far more complicated story, inflation. But our best guess is inflation's rolling over this year. Past results are not necessarily indicative of future results. Thank you.